Imagine getting a form from a payment app that shows thousands of dollars in sales and realizing half of it isn't even yours. That single piece of paper can trigger bank freezes, surprise withholding, or a panic-filled call to your tax planner. Starting for tax year 2026, the IRS will require most payment platforms to send Form 1099-K for as little as $600, and that changes the game for almost every side hustler. This narration walks through exactly what the 2026 phase-in to the $600 1099K reporting threshold means, who will start getting forms, what actually changes about your tax bill. Hint: a 1099K does not create tax the platform behaviors that create the biggest headaches. Real examples for drivers, sellers, freelancers, and mixed personal business users, and a practical, step-by-step plan to prepare for 2026 so you don't overpay, get surprised, or lose sleep. A quick disclaimer up front: this is educational only and not legal or tax advice. This explanation is based on IRS guidance, including Notice 2024-85 and the IRS pages on Form 1099K. Always confirm specifics at irs.gov and talk to a qualified tax professional about your situation. Here's the headline. The IRS provided a staged transition under Notice 2024-85. Platforms used a $5,000 threshold for 2024, $2,500 for 2025, and beginning with calendar year 2026, the statutory $600 threshold applies unless Congress or the IRS changes it again. That 600 number is not a new tax. It's an information reporting trigger for third-party settlement organizations. Think PayPal business profiles, Venmo business flows, Cash App business flows, Stripe, Etsy, Amazon, aggregated payouts. The important distinction, and where most people get tripped up, is that the reporting threshold affects whether the platform sends an informational copy of what it processed to you and the IRS. It does not change the underlying tax law that says all income from selling goods or services is taxable whether or not you get a 1099K. More 1099Ks means more visibility by the IRS, which increases audit risk if your books don't match. It also creates a lot more paperwork friction that can hurt your cash flow if platforms or banks mishandle the data. Now let's break this down into common side hustle profiles so you can see how it affects you personally. If you're a gig driver, rideshare, or delivery, and you grossed $8,000 on a platform in a year, you already got a 1099K in 2024 because that's over $5,000 in 2026. Drivers who only collect $800 through an app could now see a 1099K, even if that $800 includes personal reimbursements or tip pooling. If you're a marketplace seller on Etsy, eBay, or Amazon, small sellers who previously flew under the radar will now get 1099Ks once platform flows hit $600. That matters because marketplaces often report gross sales with no deductions for shipping, cost of goods sold, or returns. If you're a freelancer paid through payment apps like Stripe, PayPal, or Cash App, clients paying via an app may trigger a 1099K at $600. For freelancers, this increases the visibility of your gross receipts, making it even more critical to track business expenses. If you're a mixed personal business user, many people use apps for both family gifts, reimbursed gas, or friend-to-friend transfers. Platforms sometimes aggregate all transactions into one total. If your transfers show up on a 1099K, you'll need documentation to prove those weren't taxable business receipts. Who benefits from more 1099Ks? The IRS, because they get more data. Who bears the pain? The casual, mixed-use user who doesn't have clean records. So what actually changes and what stays the same? What changes is that more people will receive 1099Ks. Platforms will have to report smaller totals, expect more volume, more corrections, and more forms landing in mailboxes and email inboxes starting in early 2027 for 2026 tax year activity. What doesn't change is your tax obligation. You have been required to report income from goods and services whether or not a 1099K existed. Your taxable income is gross receipts minus allowable business expenses. If you're self-employed, you still owe self-employment tax on net profit. A 1099K only tells the IRS what the platform paid or processed. It's a cross-check tool. Here's another twist. Platforms sometimes do backup withholding or freeze payouts when they detect mismatch issues. Notice 2024 to 85 gave limited penalty relief to platforms for certain backup withholding deposit failures in 2024, but it didn't change the underlying backup withholding rules or your tax obligations. That means platform operational behavior can still create real cash flow problems for payees, even when the IRS relaxed penalties for platforms. So yes, the IRS made it easier on platforms in one narrow respect, but that doesn't stop a platform from freezing money or making you wait for corrected forms. Bad timing equals stress. Major platform practices that cause the biggest surprises usually involve reporting gross flows. That often means aggregated gross receipts with no deduction for fees, refunds, or shipping. It can include refunds, chargebacks, or pass-through payments like someone paying rent and you forwarding it. Expect late or multiple 1099Ks as platforms correct forms after they mail them or send additional forms when they change classification rules. Automated deduplication mistakes across platforms can result in multiple forms for the same customer or transaction, or a platform may accidentally include personal transfers. A common shock: a seller who thought they cleared $900 net in sales receives a 1099K showing $2,200 because the platform reported total transaction volume before refunds and returns. That inflated number can trigger IRS notices if your Schedule C doesn't match the 1099K totals. What do you do if your 1099K is wrong? Documentation is your best friend, and a correction request to the platform is step one, but sometimes the paper trail takes months. Let's run through realistic examples that show when a 1099K triggers reporting and when taxable income exists without a form. Example 1. A W-2 employee selling old furniture occasionally receives $1,200 via a payment app for the year. Tax rule: casual sales of personal items sold for less than original cost generally have no taxable gain. But if you flipped items for profit, that $1,200 is business income. Under the 2026 rule, the seller will likely get a 1099K if payments exceed $600. But even if no form arrives, taxable income still exists if it's profit. A 1099K only helps the IRS find you. Example 2. A rideshare driver who earns $25,000 gross on a platform. The platform sends a 1099K and maybe a separate statement for incentives or expenses. Tax rule: report gross revenue minus expenses on Schedule C and pay self-employment tax on net. The 1099K doesn't equal taxable profit. Example 3. A person receiving 10 $100 reimbursements from friends for a group dinner. $1,000 total shows up on a 1099K. Tax rule: if those are reimbursements or purely personal transfers, they are not business income. Document the reimbursements and ask the platform for a corrected 1099K or an annotation. The trap here is that platforms rarely separate business from personal, so the burden of proof is on you to show a transaction wasn't income. If you have any side hustle, here's a practical action plan to be ready when the $600 rule applies to 2026 activity. Step 1. Inventory your apps and flows. List every payment app, marketplace, and platform you use. Export transaction histories monthly into CSVs starting now. Step 2. Tag transactions immediately. Create 3 tags: business income, personal transfers or reimbursements, and refunds or chargebacks. Use a simple bookkeeping tool or a spreadsheet. This makes reconciling quick. Step 3. Keep supporting documentation. For each business sale, keep an invoice, delivery proof, or a message confirming the sale. For reimbursements, keep screenshots or notes showing payer intent. Step 4. Reconcile before year end. Match platform gross receipts to your business ledger and flag amounts that include pass-throughs, refunds, or non-business transfers. Step 5. Decide how to handle tax payments. If you're a W-2 employee with a small side hustle, consider increasing your W-4, withholding a little, or making estimated payments quarterly to cover expected additional tax. This is often easier than fiddling with quarterly estimates if the extra income is modest.